Hello, my name is Kerry Liger. I'm from the University of KwaZulu-Natal, the School of Accounting, Economics and Finance. Today we are talking about the discipline of accounting. We'll be looking at Chapter 1 from your Grip and Garp textbook, the Financial Reporting Environment. You'll find that Chapters 1, 2 and 3 are extremely important. These chapters are going to be pervasive throughout all of your accounting standards and all the chapters that follow on from these. Now, the three topics covered in the first three chapters are firstly the background to International Financial Reporting Standards, which is what this session will cover. The second chapter is the conceptual framework, and the third chapter, IS1, the presentation of financial statements. You will find the conceptual framework comprises of a very important and vital part of your assessments, where you will get a lot of theory and discussion type questions. Your presentation of financial statements is also vital and will be pervasive through all of your accounting standards to come. You will find that presentation skills are to be used throughout all of the accounting standards. We are now going to talk about the modern accountant. Now, through SAICA, we have a specific set of competencies and skills that you're expected to develop to be signed off as a chartered accountant in South Africa. You will find that some of these skills are going to be improvised and included within the concepts of your tutorials. Some of the specific competencies, and especially that we will be concentrating on, is accounting, where we look at record keeping, and then external reporting, which is the set of financial statements. This will be the main focus for your Accounting 211, as well as developing your soft skills and being able to work as a team. This is important to be a chartered accountant, and you cannot believe that you will be living behind a desk for the rest of your life. It is a very social job, and you will be expected to work within a team without all of your audits. The language of accounting was developed over a period of time. It was not something that was simply brought about and we had standards to show for it. We all need to understand each other, and this is where the language of accounting comes in. Now, to understand where we are today, we need to understand where we have come from. So firstly, there were a set of generally accepted accounting practices which were developed by each individual country. Each of these individual GOPs had their own set of rules and standards, and they differed between each various country. However, this caused many issues within the business world, especially when companies started to have a more international footprint. So companies started to branch out, and they had different various operations in numerous countries. But each country had their own generally accepted accounting practice. This then led to a lot of confusion, court cases, financial loss, and liquidation. You would find that when one company was provided statements in a certain country, they might have had a massive financial profit, whereas the same company being prepared financial statements in another country would have had a significant loss. This can be seen that there is a trouble with having these various GOPs per country. This then led to this international harmonization project, where it was determined that we need to come up with one single language that is universally accepted. The International Harmonization Project had the main objective of avoiding miscommunication that can be seen was arising from the various countries and their own individual GOP. So we started off with a very rudimentary debit and credit system, and this was really the basis and foundation of accounting. We then had the various countries who decided to practice and generate their own individual GOP, and where that was decided to be a problem, we then decided to provide for an international harmonization project to form one global set of GOP. This one single global set of GOP is known as the International Financial Reporting Standards. There are two projects that are also provided for, and these are the Convergence Project as well as the Improvements Project. Now, the Convergence Project is really centered around those few countries that have not yet adopted IFRS. These countries include those powerful ones such as the United States of America, who are still using their own individual GAAP as opposed to the International Financial Reporting Standards. The purpose of the Convergence Project is ultimately to get the United States of America to join with the IFRS process. They found that IFRS is more principles-based as opposed to the US GAAP, which is generally more rules-based. US has decided that their rules-based approach applies for less litigation and court cases in the long run. However, we have not seen any significant issues when applying IFRS on an international level. With the changing economic environment as well as businesses, we have a constant improvements project that needs to take place. And as business is changing and evolving, we found that the international accounting standards also need to play their part and evolve and change with these. So we do have existing standards as well as interpretations that are changed and modified in line with the changes within the business environment. Who has to comply with IFRS? Okay, in South Africa, we have our state-owned entities, and these are expected to comply with the full IFRS, as well as our listed public companies. The JSE listing requirements are very stringent. Our small to medium enterprises, in fact, have a choice between either the full IFRS or a diluted IFRS for SMEs, or alternatively SA GAAP. Most small to medium enterprises do choose to apply the IFRS for SME system, with South Africa being the first country in the world to adopt IFRS for SMEs. There's disclosure of compliance for IS1 that is required, and what this means is that on one of the first pages of your set of financial statements, there should be a paragraph that states the financial statements are free from material error and they comply with the International Financial Reporting Standards. This provides credibility to the financial statements, so the users of these financials know that this International Financial Reporting Standards has been applied when providing these financials, and these are also understandable to foreigners, which aids and encourages foreign investment. With International Financial Reporting Standards being applied on an international basis, it again provides the space for a single language and understandability across countries. Looking at the overview of the process to understand how do we end up with an accounting standard. So we start with an exposure draft. And to understand what an exposure draft is, it's really a draft process of what the standard should be. This exposure draft is then opened up to the public as well as to chartered accountants for their comments, and they can then provide their input to the final standard that will then be issued. We currently have 42 standards that are in play, as well as 20 interpretations that are to be applied should someone be complying with IFRS. Now, there are two different types of standards that you will come across. The first is IAS, the International Accounting Standards, and then the second is IFRS, the International Financial Reporting Standards. The International Financial Reporting Standards are simply applied and generated by a new board. So our new International Accounting Standards Board would be the ones that have developed that standard, which is then named an IFRS. Whereas the old International Accounting Standards Committee, the standards that they had generated are in fact labeled IAS. The same goes for their interpretations, where the new board, the interpretations are labeled IFRIC, and the old committee, the interpretations are labeled SIC. What is important is that while we do have interpretations, which are really just an expansion and added value on the initial standards, these do have the same authority as the accounting standards themselves. So they are not to be ignored and not to be used as supplementary information. They do have just as much importance as the accounting standards. Looking at company legislation and related governance, we will look at the Companies Act as well as the King IV report. There were big changes that came into effect with our New Companies Act from 2008. It became effective from the 1st of May 2011, with shares no longer being issued at a par value. A par value was an arbitrary value that was assigned to shares when incorporating a company. These were generally at a value of R1, and should you have clients out there in the commercial world that were established prior to 2008, you might find in their share register they might have shares at a par value. Now, what happened was this par value, when shares were sold, was accounted for as the share capital value. For example, if you had a share that had a par value of R1, but it was sold for R30, you would then record share capital at R1 and share premium of R29. Both of these share capital and share premium accounts were found within the equity section of the Statement of Financial Position. It was deemed quite irrelevant to provide for the split between share capital and share premium, and thus the notion of a par value was removed. Closed corporations are no longer to be created under the New Companies Act. That does not mean that they cease to exist. Any that existed prior to the Companies Act of 2008 would have still existed and still exist today. The fact is just that there are no more CCs, closed corporations, that are to be incorporated and created. Companies are now divided into two broad categories, being non-profit and for-profit companies. Our non-profit companies are simply a category on their own, whereas profit companies are further subdivided into 4 categories. The AFS, the annual financial statements, are to be published within 6 months of financial year end. This aids the timeliness qualitative characteristic that we have under our conceptual framework. Companies also have the contractual powers to act as a natural person, which is important when engaging in contracts and legal agreements. The new categories of companies, as we said, the profit companies, are further split into 4 main categories: our state-owned companies, private companies, personal liability companies, and public companies. Our main focus for accounting too will be on private companies and public companies. Your other forms of ownership, such as clubs, your partnerships, as well as sole traders, were learnt in first year and are not recovered in second year going forward. Differential reporting really looks at the level of compliance to which a company is providing their set of financial statements. It allows smaller entities to produce annual financial statements using simpler standards as opposed to IFRS, such as IFRS for SMEs. IFRS for SMEs is a simpler and cheaper option for your small to medium enterprises. They do not have to undergo complicated policies and compliance with the standards, and it is a lot cheaper for them to implement. You do not need the use of experts to provide for valuations, and therefore you can avoid such costs. To understand IFRS for SMEs, we first need to know, what is a small medium enterprise? They in fact have no public accountability. Now you'll find that they do often still produce general purpose financial users for external parties. However, these are going to be voluntary in nature. When does a company have public accountability? So it is when their debt or equity instruments are publicly traded. You will learn more about debt equity instruments under financial instruments. For now, we could read that as being shares. So, to re-understand ourselves, their shares are publicly traded. That means that they are involved on some sort of stock exchange and the public can buy and sell shares as they wish. They have the legal authority to make financial decisions for a group of outsiders. So public accountability means that the owners of this particular company are not involved in the day-to-day running of the business. To understand the Companies Act, there are quite a lot of stringent requirements. You will learn more about this in Auditing 200, but we do cover the basics in Accounting 211. The company records are to be kept in writing and for a period of 7 years. The financial year is to be a period of 12 months, 365 days, and it can be a maximum of 15 months. There are instances where companies perhaps have a 3-month startup period and then want to start with their full financial year. This would result in a 15-month financial period. There can also be adjustments to the financial year end. A company may choose to change their year end from December to February in line with the South African Revenue Services. If they did that, their financial year for that particular period would be 14 months. This must be very clearly stated at the top of their financial statements to be able to ensure comparability purposes. The accounting records will provide for any policies that the company has chosen, as well as how they have reached these conclusions. The financial statements, which you are aware of, must comply with the accounting standards and prepared under that basis. They must be shown and provided to the users of the financial statements within 6 months of financial year end. They may require either an audit or an independent review, which would be dependent on their public interest score. You will learn more about that in Auditing 200. There are also other documents that are included within a set of financial statements that are more soft-spoken, as well as the director's report and the auditor's report. The JSE listing requirements are very onerous. They are very numerous and stringent. They require many various requirements. The JSE listing requirements are in fact aligned with the Companies Act itself, so it does act as a double checkpoint to ensure compliance with the Companies Act. 2 sections from the JSE listing requirements that are brought to your attention within your Gripping GARP textbook is firstly Section 3 in terms of continuing obligations. The annual financial statements here are in fact required to be issued 4 months after year end, as opposed to the Companies Act less stringent requirements of 6 months after year end. The JSE also requires that these financial statements must be provided at least 15 business days before the annual general meeting. Section 8, financial information. Information to be included in the prospectus. Now, what is a prospectus for a publicly listed company? A prospectus simply is an invitation to the public to purchase shares in the company. This prospectus cannot simply be an invitation. It does have certain requirements in terms of information provided to the public. It must include the annual financial statements and annual reports, as well as an analysis of directors' remuneration. The King IV report. Whilst this is not a compulsory report for most businesses, those that are listed on the JSE are expected and required to comply with the King IV report. Whilst for other companies it is voluntary, it is deemed to be an acceptable practice to follow the King IV report. You will find that most companies do choose, in fact, to follow the King IV report, as it provides a good code of conduct and good corporate governance for companies. This replaces the King III report, and again, as the business environment changes and adapts, so do we have to adapt our policies and reports of compliance. And this is where the King IV report was refined and developed. Like we said, it is not a legal requirement for businesses to comply with. However, for JSE listed companies, it is a mandatory requirement. The key aspects included are centered around the concept of ethics. It is important to ensure that those involved in the day-to-day running of the business practice a good ethic culture. Importance of sustainability in reporting in terms of integrated reports. Your sustainability reporting has become more topical, and those users of the financial statements are no longer simply interested in the economic information. They do expect economic, environmental, and social information to be included within the financial statements. Whilst the King IV report is recommended to all companies, there are certain items that are specifically included, such as disclosure of remuneration to directors and senior executives, which helps to address the payment gap between those higher earning employees and those lower down on the payment scale. It also assists with sustainability reporting. How is this business going to continue to operate in the environment and the community within which they are situated? The King Report on Remuneration has become more topical as time has gone on, and especially within South Africa. The principle of the remuneration report is to be fair, responsible, and transparent. This report will consist of the organization's remuneration policy, the context in which they provide their remuneration, as well as an implementation report. They also do not have to leave it there. They are required to address this gap between executive management and all other employees. While this is fairly new, it is interesting to see how these payment gaps are being addressed through the sets of financial statements that are available to us. Some interesting ways to address the gap is the inclusion of employee share payment schemes, where employees are able to get a portion of the shares in the company, which will give them distribution rights, dividends rights, as well as capital appreciation in the value of the shares. Sustainability and integrated reporting. Sustainable development is the concept of meeting the needs of the present without compromising the ability of future generations to meet their own needs. With integrated reporting, it is important that all your sections speak to each other. So your social, your environmental, and your economic aspects must all be congruent in their message. They should not be conflicting and provide conflicting messages. Your triple bottom line reporting provides the economic, social, as well as environmental issues the entity is facing. They must provide information about the society and community within which they operate, how they are looking after their employees and any potential programs they may have in play, as well as environmental issues. How are they operating within the environment? Are they responsible? And are they ensuring the reduction of their carbon footprint?